Hey, wealth builders, welcome. Comment the country you're tuning in from. Let's see how global our squad really is. Have you ever dreamed of living without having to work every day? To be able to enjoy your life without being dependent on a paycheck each month? It's a dream that seems distant for some, almost unattainable. Maybe you think it's reserved for the wealthiest or those with immense fortunes. But in reality, it's not as complicated as it seems. There's a method, simple, clear, and accessible, that allows you to create passive income and live off your investments. Today, I'm going to share with you a method that has already changed the lives of thousands of people around the world, a method that relies on a simple but powerful principle. Invest intelligently to create passive income. If you've never invested before, don't worry, because what I'm going to explain is perfectly understandable even for a beginner. This method, which I'm about to present, is based on concepts from a famous study conducted in 1989 by economists from a well-known American university. This study is known as the Princeton Study, and it demonstrated that you don't need a fortune to live off your investments. What you need is a clear strategy and regular investment in assets that generate passive income. This principle, which I call the 5% rule, is the secret that allows millions of people worldwide to free themselves from financial constraints. In this video, I'm going to explain how this rule works, where it comes from, and how to adopt it, even if you've never invested before. I will also give you concrete examples, practical strategies, and mistakes to avoid so you can start today to build a stable and prosperous financial future. It's a method so simple that by the end of this video, you will know exactly what you need to do to start building your financial independence. Before getting into the details, let me tell you a story. A few years ago, I met a man, Mark, who at 45 was in a tough financial spot. He had worked his whole life in a job that didn't excite him, living paycheck to paycheck. But everything changed the day he discovered the 5% rule. In less than 5 years, Mark managed to accumulate enough capital to live off his investments. And all of that thanks to a simple but powerful strategy. The 5% rule is based on a fundamental principle. With a well-diversified investment portfolio, you can withdraw a small portion of your capital each year without ever touching your initial savings. This means that you can grow your money, let it appreciate over the years, and live off its returns without ever touching your initial capital. In Mark's example, he used this rule to determine how much money he needed to stop working. By investing intelligently in a portfolio made up primarily of stocks and bonds, he managed to create a passive income sufficient to cover his needs. Today, Mark lives comfortably, without having to worry about his financial future. But the 5% rule isn't just a theoretical concept. It's a principle based on solid data and decades of economic observations. This method has been tested over time and proven to work. It allows you to create an investment portfolio that works for you, generating passive income on a regular basis. And it doesn't matter if you start with $10,000, $50,000, or even $100,000. Imagine for a moment that you have a portfolio worth $1 million. If you follow the 5% rule, you can withdraw $50,000 each year without ever touching your capital. And even if the markets are volatile, even during a crisis, your portfolio can still generate enough income to cover your needs. This changes everything, doesn't it? I will show you all of this in concrete terms. If you want to start applying this method, here's what you need to do. Start by defining your annual financial needs. For example, if you need $30,000 per year to cover your expenses, the 5% rule tells you that you need a capital of at least $600,000 to live solely off your investments. In other words, if you want an annual income of $30,000, you won't need to work, provided you invest regularly and intelligently. I will also give you specific examples of investments that follow this rule. But before that, know that, like any method, there are limitations. The 5% rule isn't a magic solution. It is based on specific assumptions that must be respected. In the second part of this video, I will talk to you about the risks and limitations to consider to ensure that you achieve your financial goals. Now that you understand the basics of the 5% rule, let's dive deeper into how it works and, more importantly, the limitations you need to be aware of when applying this method. While the rule can seem like the perfect blueprint for achieving financial independence, There are some factors you must consider to make sure your portfolio continues to work for you in the long run. First, let's take a closer look at what's behind the 5% rule. As I mentioned earlier, it's based on a principle of withdrawing a fixed percentage from your investment portfolio each year. Historically, portfolios with a balanced mix of stocks and bonds have generated a long-term return of about 7% per year before inflation. The rule suggests that you can safely withdraw 5% of your portfolio each year without diminishing your capital. This means if you have $1 million, you can withdraw $50,000 every year, and your portfolio should, in theory, last for decades without running out of money. But here's the catch. Not all portfolios perform the same. The exact mix of assets in your portfolio plays a crucial role in determining whether or not the 5% rule will work for you. A portfolio with a higher percentage of stocks may generate better returns, but can also be more volatile. On the other hand, a portfolio with more bonds may be less risky, but the returns could be lower. The key is diversification, having a mix of different types of assets in your portfolio. If your portfolio is well diversified, with a balance between stocks, bonds, and other assets, you have a better chance of achieving the returns needed to follow the 5% rule effectively. For example, a portfolio consisting of 60% stocks and 40% bonds is often recommended as a good starting point. Historically, this mix has produced average returns of about 7% per year, which is sufficient to meet the 5% rule. But here's where things get interesting. When we talk about achieving financial independence, we're not just discussing how much money you need to retire. We're also talking about how you can maintain that independence and live comfortably over time. One of the biggest risks when applying the 5% rule is inflation. If inflation rises too much, your $50,000 annual withdrawal may no longer be enough to maintain your standard of living. Imagine that inflation rises by 3% per year. That means the purchasing power of your $50,000 decreases over time, and you might find yourself needing to adjust your withdrawals. To combat inflation, it's important to invest in assets that outpace inflation over the long term. Historically, stocks have been one of the best ways to hedge against inflation. However, even stocks can be volatile in the short term. This is why you need to stay disciplined and patient with your investments. Another important factor to consider is the possibility of financial crises. As we've seen in the past, markets can be unpredictable, and a major crisis can cause a significant drop in the value of your investments. For instance, during the 2008 financial crisis, many portfolios saw a substantial decline in value. If you rely solely on your portfolio to fund your lifestyle, a sudden drop in the market could leave you struggling to meet your financial goals. The key to surviving market downturns is flexibility. If you encounter financial crisis, you may need to reduce your annual withdrawals temporarily. Instead of sticking rigidly to the 5% rule, consider adjusting your withdrawals to 4% or even 3% until the market recovers. By maintaining flexibility, you can ensure that your portfolio lasts for the long term, even through turbulent times. In addition to flexibility, you also need to consider your cash reserve. Having a cash reserve, a portion of your capital set aside in a liquid form, can help you avoid having to sell off assets during a market downturn. This reserve should cover at least 6 to 12 months of living expenses. By having a safety net in place, you won't be forced to sell your investments at the worst possible time, which can prevent you from suffering irreversible losses. But even with all these precautions, you still need to be mindful of one thing: patience. Achieving financial independence and living off your investments takes time. It doesn't happen overnight, and it requires discipline and commitment. You need to save consistently, invest wisely, and avoid panicking when markets fluctuate. The reality is that building a portfolio capable of generating enough passive income to replace your salary can take many years, often 10, 15, or even 20 years. This is why the 5% rule isn't a get-rich-quick strategy. It's about setting yourself up for long-term financial stability by making smart, disciplined investment decisions. Let's take a closer look at how you can apply this strategy in real life. For example, if you need $40,000 per year to live comfortably, the 5% rule tells you that you need to save $800,000 to achieve financial independence. But remember, the $800,000 is just an estimate. You should plan for a margin of safety, and a good rule of thumb is to add 10 to 20% more to your target capital. So, instead of aiming for $800,000, aim for $880,000 to $960,000. Once you establish how much you need, the next step is figuring out where to invest. A well-diversified portfolio, consisting of a mix of stocks, bonds, and other assets, is your best bet. But there are also specific investment vehicles that can help you achieve the 5% rule more easily. Exchange-traded funds, ETFs, for example, are an excellent option for beginners. ETFs allow you to invest in a broad range of assets without having to pick individual stocks or bonds. This makes it easier to maintain a balanced, diversified portfolio. There are many ETFs out there, but some are particularly well suited for achieving the 5% rule. For example, the Vanguard Total Stock Market ETF, VTI, gives you exposure to a wide range of stocks across all sectors, providing broad diversification. Another option is the iShares Core U.S. Aggregate Bond ETF, AGG, which invests in a diversified mix of bonds. But remember, the key is to choose a portfolio that fits your risk tolerance and investment goals. By regularly contributing to your portfolio, staying disciplined, and being patient, you can eventually achieve financial independence and live off your investments. Now that we've established the basics of how the 5% rule works and the factors to consider when applying it, let's explore some of the most common mistakes people make when trying to build a portfolio for financial independence. Understanding these pitfalls will help you avoid costly errors and set yourself on the path to success. One of the most common mistakes people make is underestimating the power of compound interest. Compound interest is one of the most powerful tools at your disposal when building wealth. It's the concept of earning interest on your interest, which leads to exponential growth over time. The longer you allow your investments to grow, the more powerful compound interest becomes. Let's take a concrete example. Suppose you start investing $500 per month at an average annual return of 7%. After 10 years, you'll have invested a total of $60,000. But thanks to compound interest, your portfolio will have grown to more than $100,000. The longer you stay invested, the greater the impact of compound interest, and the easier it becomes to reach your financial goals. The key here is consistency. Regular contributions to your portfolio, even if they seem small at first, will pay off significantly in the long run. Another mistake people make is chasing high returns without considering risk. It's easy to get caught up in the hype of high-growth investments, such as tech stocks or cryptocurrency. While these investments can offer high returns, they also come with high volatility and risk. When trying to achieve financial independence using the 5% rule, you want to focus on building a portfolio that balances risk and return. For example, investing too much in high-risk assets like individual stocks or speculative investments can lead to large fluctuations in your portfolio value. If you're relying on your portfolio to provide consistent income, these fluctuations can make it difficult to maintain a steady withdrawal rate. Instead, focus on a diversified mix of low-risk and high-risk assets, ensuring that your portfolio can weather market downturns and still generate the income you need. A third mistake is failing to adjust your strategy based on changing life circumstances. Life happens. You may experience changes in your income, expenses, or financial goals. It's important to revisit your investment strategy regularly and make adjustments as needed. For example, if you get a significant pay raise or reduce your living expenses, you may want to increase your monthly contributions to your portfolio. Conversely, if you experience a major financial setback, you may need to adjust your withdrawal rate temporarily to ensure your portfolio lasts for the long term. This flexibility is key to long-term financial success. The 5% rule isn't a rigid system that must be followed exactly. Instead, it's a guideline that allows for adjustments based on your individual situation. For example, if you're in the early stages of building your portfolio, you may choose to save and invest more aggressively to accelerate your progress. As you get closer to financial independence, you can shift towards more conservative investments to protect your capital. Another important factor to consider is emotional discipline. The markets can be unpredictable, and it's easy to get caught up in the fear and panic during periods of market volatility. But remember, the 5% rule is designed for the long term. It's important to resist the urge to sell your investments when the market dips. Selling during a downturn can lock in losses and derail your financial plan. Instead, stay calm, stick to your strategy, and allow your investments to recover over time. Think about it. If you had sold your investments during the 2008 financial crisis, you would have missed out on the incredible recovery that followed. Staying disciplined, even during tough times, is one of the most important habits you could develop as an investor. Over time, market fluctuations become less significant as your portfolio grows and starts to generate passive income. One final mistake people often make is underestimating the impact of taxes on their investment returns. Depending on the type of investment account you use, taxes can eat into your returns and reduce your ability to achieve financial independence. To minimize taxes, consider using tax advantage accounts like IRAs or 401k, in the U.S., or similar tax-efficient accounts in your country. These accounts allow your investments to grow tax-deferred or tax-free, meaning you can keep more of your returns. In addition to tax advantage accounts, be mindful of the type of investments you hold. Some investments, such as dividend-paying stocks or bonds, may be subject to higher taxes than others. Understanding the tax implications of your investment strategy can help you make more informed decisions and keep more of your money working for you. Lastly, don't forget about reinvesting your dividends. When you receive dividends from your investments, it can be tempting to take them as cash. But if you want to accelerate the growth of your portfolio, consider reinvesting those dividends back into your investments. Reinvesting dividends is a powerful way to increase your portfolio's value over time and help you achieve financial independence more quickly. Now that you have a solid understanding of how the 5% rule works and the common mistakes to avoid, let's take a moment to recap and bring everything together. By now, you should see that achieving financial independence is not an impossible dream. With patience, discipline, and a well-thought-out investment strategy, you can gradually build a portfolio that works for you, generating the passive income you need to live comfortably without working. The 5% rule is an incredibly powerful tool, but it requires you to stay committed and focus on your long-term goals. The key is to start early, invest regularly, and stay disciplined. Whether you're just starting or you're already on your way to financial independence, it's important to understand that every small step you take towards your goal brings you closer to achieving the life you want. One of the most motivating aspects of the 5% rule is that it makes financial independence seem possible for everyone, not just the rich or the lucky few. By following a few simple principles, like diversification, risk management, and the power of compound interest, you can start to see real progress in your financial journey. Let's break it down into 3 essential takeaways that you can implement today. Define your financial needs. Determine how much money you need annually to live comfortably. The 5% rule can help you calculate the capital required to meet that goal. Use a formula multiplying your annual income needs by 25 to estimate the capital you need. Diversify your investments. Build a balanced portfolio that includes a mix of stocks, bonds, and other assets. This will allow you to capture growth in the markets while managing risk effectively. Diversification will help you weather market volatility, which is essential for long-term success. Stay patient and flexible. Building a portfolio for financial independence takes time. There will be ups and downs, and you must remain calm and stick to your strategy. Flexibility is key. If you encounter market downturns or financial crises, adjust your withdrawals and investments accordingly. Having a safety net and a plan for unforeseen events will give you the stability you need to stay on track. Additionally, if you're looking to accelerate your financial independence, you can consider using tools like ETFs, which provide an easy way to invest in diversified assets, or tax advantage accounts to maximize your returns. By taking a smart, disciplined approach to your investments, you can create a portfolio that generates passive income and grows over time. Remember, achieving financial independence is a journey. It won't happen overnight, but with consistent effort and smart decisions, you can build a life you've always dreamed of. The 5% rule isn't a magic solution, but it's an incredibly powerful framework to help you achieve your financial goals. Whether you're looking to retire early, pay off debt, or simply build a life of financial freedom, the 5% rule gives you the roadmap to get there. So what are you waiting for? Take the first step today. Start saving, start investing, and start building your financial future. Comment below how much money you think you need to retire comfortably and live off your investments. I'd love to hear your thoughts. Thank you for watching this video. If you found this information helpful, give it a thumbs up, share it with your friends, and don't forget to subscribe for more videos on financial independence and investing. Remember, it's never too late to start making your money work for you while you sleep.